all your guests, if they have questions, I'm here to answer questions. Obviously, I can talk about self-directed IRAs and the benefits for probably three days before I get tired. And everybody comes in at different levels. But my mom and dad were in real estate, and their moms and dad were in real estate. And I just returned to South Florida. I grew up in Fort Lauderdale. My mom and dad moved there when I was 2 years old. And then I went north to Cornell University. Leaving Fort Lauderdale, Florida for upstate New York was a definite mistake from a weather standpoint. Education was good, but weather-wise, it was very gloomy compared to Lauderdale. And after graduation, I went to Kennedy Space Center and worked on the R&D, research and development of the shuttle program, and loved launching rockets. It was probably one of my fondest memories. But at the same time, I was doing real estate as well because I just grew up around it, and it was a way to make money. You'll make more money in real estate than you will launching rockets, but I don't know that you'll have as much fun. So my mom and dad were in real estate. Their moms and dads were in it, so I learned about it. And then when I found out about self-directing IRAs, where you could have rental income tax-free for the rest of your life, and when I started out, I could push it to where my kids and their kids could use it, but those laws changed a year or two ago. But it's still great for when you're alive, and for a decade after you die, people can reap tax-free, or at least tax-deferred income from their real estate investments. And not only buying real estate and renting it, but a lot of people don't like the hassles of tenants and maintenance, et cetera. So they will lend money and be the bank for a lot of real estate investors, especially rehabbers, et cetera. And you can do that out of your self-directed IRA. And then you have some more traditional investments, such as private placements, where people will get into investments that are syndications that would buy an apartment building, or office building, or something, bigger, where they'll put a lot of people together. So they'll do that. And then the other portion that most of our people do is buying metals such as gold, silver, palladium, et cetera. So there's a lot of different opportunities to use self-direction, but one of the main things we ask people to do is invest in what they know and understand. I hate when people get either stock tips or great tips on this or that and don't do their due diligence. Do your due diligence. Do your due diligence on every investment that you take. Do your due diligence on Broward or Miami-Dade REIA. Do your due diligence on Camaplan. It's a lot better to do your homework up front, instead of waiting for a problem to come up and then figure out who you're dealing with. So I love the real estate investment associations. They teach people how to get into real estate, and we teach them how to make it one step better by having tax-free income for their life. And most people like that. I mean, that was the one thing that really appealed to me when I got into this business.
What about, Carl? I know a lot of people, and I put a poll up there to see if, they have something for retirement right now. And I know people are answering it. And well, the good thing is I see a lot of you guys do have something, which is great. I see more than half of you guys don't have something that's self-directed. Do you want to explain what it really means, self-directed? Or, I have a Roth IRA at Fidelity Investments or Charles Schwab, or what's the difference between, something like that versus self-directed?
No, that's a great question, because we started our company about 18 years ago, 19 years ago, and they said, well, I have a self-directed company at Fidelity, and the one difference is Fidelity will let you invest in anything you choose that they sell. Okay. If they sell it, you can tell them to buy it for you. Camaplan doesn't sell any investments. We don't endorse any investments. We don't recommend any investments. Now, my personal background is I like tax-free, and I'm biased towards that. And I also am biased towards real estate because I know it, understand it, and I grew up about it. So that'll come through. But we don't recommend any of that. Camaplan will never have a deal of the month. They'll never have a note for you to invest in or a piece of real estate. So when we say self-directed, it's truly self-directed, and you get to choose what to invest in, whether it's the house next door, the apartment building in town, the office complex where you work, piece of land. You know, it doesn't matter. You can choose any of those investments that you're good at and that you like and that you understand and you know the risks. So all the rules are exactly the same for our IRA as Fidelity's or any, you know, Vanguard's, anybody else's. All the contribution limits, all the distribution requirements, everything is exactly the same. You can roll your money from Fidelity or one of the other brokerage houses to Camaplan. There is no tax implications associated with that. So if you open up a self-directed IRA, there's a couple ways to fund it. One of the most used ones is they transfer some or all of their money from their existing IRAs, because all I hear now is people are worried that the stock market has gone up and up and up and it's high, and they don't know how much longer it's going to be, and they don't know where to put it. But in that same vein, especially here in South Florida, you can see that real estate prices have gone up and up and up. And I don't know if that's going to come down or not with all the Northeasterners moving here. But those are some of the decisions that, you know, when you self-direct, you have to make a decision about where you're going to put your money. Obviously, self-direction, true self-directions let you diversify out of the market and buy things that don't necessarily correlate to the market. So it makes your portfolio that much stronger, in our opinion.
Absolutely. And I know, like, so the other thing I'm going to add to that is that, you know, when I had my friend doing my financial planning, and what I never checked was the fees, right? So there's always a cost. I never really thought about it. I was like, okay, it's in some mutual fund that I've never heard of. And, you know, for me personally, it wasn't growing fast enough, so I wasn't excited. And one of my issues was that I thought I didn't have enough money. I'm like, oh, I can't buy real estate in this. So what would you tell someone that's, you know, new to real estate, or they don't have a ton of money, right, from their corporate job or a 401k, and, you know, is it too late, I guess, really, to ever start a Roth IRA or an investment vehicle, is probably what I would ask.
Well, in my opinion, no, it's never too late to start one. We have a booklet, and we'll make it available to you, Nish, after this meeting, so you can pass it to your members. But we've got ways, you know, 20 ways that you can take a little bit of money and work it to, you know, I call it jump starting your IRA or your Roth IRA. You know, things like, you know, maybe you take an option out on a piece of property, a lot like you buy an option in the stock market. You know, you can partner with other people. You can lend your money and deal with other people that are into bigger deals. You can go to syndications, just to name a few of them. But your point about the fees is, our fees are basically listed all on one sheet. We make it very clear in the beginning. We don't take commissions. We don't share in your profits. But by the same token, we don't share in your losses either. So what I would tell people is, number one, invest in what you know and understand. And if you're new to real estate, the last thing I'd say, I mean, you know, even if we make a couple $100 on your account, I don't want you investing in real estate till you learn the aspects of it. Go to some of your classes, go to some of your education events, get a mentorship out of Broward REIA or the area that you're listening from. But really don't make investments in things you don't understand. I think even Warren Buffett, you know, has a quote, something like that. So that's what I say. And there's ways to do it. And I think going to Broward REIA, you know, listening to some of the Camaplan educational scenarios will give you some ideas. But talk to the people that have IRAs and 401ks. It's something that the government gives you, and they reward you for saving versus spending everything. So they give you tax benefits in a lot of cases. You can do it with your health savings accounts. You can do them with your kids' educational savings accounts. You know, you can put a little bit money in all those accounts and put those accounts together and buy different assets out there, or the same asset and the prorated share. So there's all kinds of ways to do it. And if you can take advantage of not paying taxes, I think that's, you know, that's one of the biggest wealth building tools that you can have in your toolbox.
Absolutely. And I know we have a lot of newbies too. So I'm pretty nerdy about the self-directed world. And obviously Carl is, you know, a true expert. Do you want to kind of maybe just explain the difference between a traditional and a Roth? Because I know some of the accountants, I'm not going to pick on any accountants, but if they're not real estate people, hey, you should open up a traditional IRA versus a Roth. And you want to maybe just like the basics of, I guess, what an IRA is and all that other good stuff.
Sure. No, that's a great question. And I appreciate you asking it, Anish. The individual retirement accounts the government set up back in the late 70s to allow people to save and control their own retirement funds versus when I graduated school, you know, you basically were putting it into a 401k or a company pension plan, and the company controlled it. But now they've made up these tax advantage plans, and the traditional IRA is one that you get a tax break on, and that's the one you're referring to. The accountants, the CPAs say, grab this because they always want to defer taxes. You know, even at 70 years old, they're talking about deferring taxes to people. And I think it must be a quiz on their test to get their CPA license. I'm not sure. But so if, let's just say you made, you know, $50,000 and you put $5,000 into a traditional IRA, you would only pay tax on $45,000. Okay. If you made $50,000 and you put $5,000 into a Roth IRA, you would pay taxes on the whole $50,000. Now the difference is all that money is growing. Let's say you did that at, you know, 30 years old. At 60 years old, when you came to take that money out, and let's say you put that 5,000 in and you developed it, you know, over those 30 years, and it became 500,000. Now, all of a sudden, when you pull that money out in the traditional one where you were getting the tax benefits, you're going to be taxed at that point. So you have to play a little game. Am I going to be taxed at a higher rate when I'm older? Am I going to be making more money? Will I have more money? What's the tax rates going to do, et cetera? So all that goes into your calculations. And I do recommend you talk to your CPA at that point in time. However, a lot of people talk about making returns of, you know, 3, 4, 5, 6%, especially today. I mean, you can't get a CD in, you know, over a, you know, like a 1.5%. And by the way, that isn't going to make much difference because inflation is close to that, and it's not going to change your lifestyle. But Anish and Ryan, you guys know that in the real estate world, you can see some quick profits depending on times and cycles. And I guess if you're good in the stock market, which I'm not, you can come up with some of the same things. And again, you should look at your Roth and traditional. But the idea is, if you have been taking these tax breaks, those, you know, 30 years, when you take that money out, you're going to be taxed. That whole 500,000 in the Roth IRA is going to be tax free.
Yeah,
So
and that's a big change in wealth. I know,
sure.
again, like accountants always, they're trying to save you taxes now, but if you're actually like, you know, being in real estate, I think I don't know if I told you, but Ryan and I bought a house in December for 52,000 bucks in Hollywood, and we bought it with our IRAs, and we flipped it to me, and we sold for about 180, and we did nothing to it. We wholesaled the house.
So
To make that money, yeah, tax free, you know, about 60,000 each. If you take, you know, we probably saved 25,000 plus each on taxes, just by putting in the right vehicle.
yeah, and you tripled your or quadrupled your IRA 401k. There's another example of what you can do with a little bit of money, right? And that isn't me talking about it. That's something you did. You have the paperwork. It's on the Broward County tax records.
Absolutely.
So you know, you can see those things, and I like that. But you know, real estate investors can't go to Christmas parties and say, "Hey, I made, you know, 400%," because it doesn't register with what
Right.
people were taught. But you know, unless it's with other real estate investors.
Or here's my favorite one. No, you probably get this all the time. If I get one more person that tells me a Roth, like it's illegal, that can't be possible, right? You probably get that all the time. What do you mean it's tax free forever? So it's always kind of funny when people don't know, and some of these people are way smarter than I am. It's just that they've never used these vehicles or really learned it, or it's not as beneficial for them. So I think it's kind of funny. I mean, you must get that all the time. And I think you were telling me the story when you first did your your retirement that you weren't sure if you're going to get your money back.
Oh
Your
yeah.
project.
Yeah. No, when I first did this, I wasn't sure whether or not it was true or not, you know, and everybody was against it, but that was, you know, 20 years ago, and there weren't any books out on the subjects. The IRS had very little in their publications about it, and you had to be, you know, in the wealthy categories to even look at it. I mean, I went back to, you know, the Ivy League libraries to find information on this. I called up the IRS. So yeah, no, it's you know, the whole IRAs were there, and it wasn't until 1998 that Joe Roth, the senator out of Delaware, came up with this plan that was named after him. And at first it wasn't allowed for the wealthy. They had to have, you know, some specific strategies to get into this arena. And there were wealth advisors that came up with different strategies for that. In 2010, they changed the law and they allowed people to roll over or convert their traditional IRAs to Roths. And the benefits of that is, one, you don't have to take required minimum distributions when you're 72 if you don't want to. Two, you're locking in the rate that you're at today. I don't know where your guests feel taxes are going in the future, but in my lifetime.
Yeah, if you look at the poll, more than 75% of our group thinks taxes are going to go up. You know, so there's a few of you that didn't even think about the tax, you know, problem that you may have. And then there's some super optimistic people that think that taxes might go down a little bit. So yeah. I think that's one of the challenges. And there's a couple of things that you talked about. So like the RMD. So do you want to explain what that really means at 72? And I'll even, you know, kind of talk about one of our members that I know for a fact that's in that situation also, what's happening with them.
Yeah, I mean, basically what you're doing when you take that break from the government, when you put the traditional IRA money into the government and they let you take that off of your income, basically you put that money in and don't pay any taxes on it. You've created a partnership with the government. Now, what they say is by the time you're 72, you have to start taking that money back out. They just changed the law where you can keep putting money into it, but you have to take the money out and you have to pay taxes on that amount of the money. And guess who figures out how much money you have to take out and what the taxes are? That's the government. You know,
Yep.
that's worse than your spouse, in my opinion. You know, who would you cut that deal with? You know, down the road, you're going to tell me how much I take out and what the tax is going to be. And they make, administrators like us report how much is in your IRA every year to them. So, none of it is hidden, but they're giving you a good break by letting you put that money in there, taking a tax break now. And I think that's great for people that have their kids, et cetera.
Yeah, and the thing is, like, we have a member that I spoke to. He's actually turning, he's near that 70 range, and he's in a business, and his business is killing it. Like, he's making like, 400,000 or 500,000 a year. He is beyond upset that he has to start taking out money. He's
well,
like,
yeah,
I don't.
and he's getting taxed at the high rate if he's making that amount of money. Now, what he should do is, if he's going to pay taxes on it anyway, he should start converting that before he gets to 72, because you can convert a little bit every year, right? Maybe you got 100,000 now, and you want to take 10,000, over the next 10 years and start converting that traditional to a Roth before they require you to take that distribution.
And it's funny because my dad's actually 81 and he had a traditional. I've been converting it into a Roth every year, speaking to my CPA to make sure, he doesn't go above the limit. And now, his last bit got converted this year. So it's, it's a win-win for myself and my sister. Learning these little things and not paying taxes because he doesn't really have any income coming in, or limited taxes. Let me rephrase that. It's helped out a lot.
Sure. Now it's easier for you to plan the future as well, because he's not going to have that tax bite as it goes. And if his Roth IRA keeps making money, he can have a higher standard of living. So converting to the Roth, allows you to take a variable out of the future, figuring it out. You know what your taxes are today, and I always say, make lemonade out of the lemons you're given. And if you go back to 2008 and 9 and you see the real estate market, there were a lot of realtors that didn't make any money because real estate pretty much came to a screeching halt. And they did a lot of conversions at that point in time because they could use the losses to offset the taxes. So there's different strategies out there. Again, I'm a big proponent of Roth IRAs, but talk to your accountant. Most of them are going to talk to you about putting it off. When I opened up my Roth IRA when they first started in 1998, I'm one of the baby boomer generation, and I just felt that Congress was always screwing us, and the whole generation. And when they did that, I didn't know about the Roth, and I wasn't that smart on it. But I said, well, they're only going to half screw me, so I'm going to convert half of my IRA, and whichever one works out better is the way I was. So I converted half of my traditional IRA in 1998, and I was allowed to pay the taxes over a couple of years. And obviously, once you have one, you start to understand it and see it. And you do have to wonder, and believe if it's true, because it did seem too good to be true that I could grow this and not pay taxes. And I still have clients that don't believe it, and they think the laws are going to change. And but it's been over 20 years, and the laws have changed a little bit, but it's still tax-free. And I think it's, you know, one of the best things since sliced bread.
Absolutely. I agree with you also. So Fernanda's actually asking me, you were talking about rental properties and you're self-directed. So she was asking, can you explain how you can own a rental property in your self-directed IRA? So I'm going to start with number one. It cannot be your primary home.
Right.
No.
Right. Quote, rental property, right?
Correct.
And you can't rent to yourself because you're disqualified of dealing with your IRA. But yeah, let's take a simple analogy, right? Right now, you work and you put money in your IRA or your 401k at work. You take that cash you earned, you put it in there. And for most of you, you buy mutual funds or stocks and bonds, you know, or one of the other assets that they offer. It works pretty much the same thing. Instead of putting your money with Fidelity or Vanguard, you come to Camaplan and you bring the cash to Camaplan, either out of your contributions from your work or from a transfer or rollover from an old 401k. And your asset that you're buying instead of a stock or a bond is now a rental property. And it might be the house next door to you. It might be a house in Indiana. You know, it can be any property. And maybe you don't want any work with it. And you don't want any tenants and you just don't want to be in cash. You might want to buy a piece of raw land and wait for the appreciation of it. It's your choice of what you're going to buy. And once you do that, you'll basically open up your account, you'll get the money in there, and then you'll find the property. And once you find the property, you'll fill out the forms associated with buying it. And it's basically the same contract you'd use to buy any piece of property. The only difference is instead of you buying it personally, it's going to be your IRA. And the way that gets titled on the contract and also on the deed is it'll say Camaplan for the benefit of Anish Davi's IRA or John Doe's IRA or who asked the question? Mary?
Fernanda.
Amanda, you know, yeah. So it'll be Amanda or Fernando's IRA. And all the paperwork will be generated. The money will come out of your IRA and given to the title company. The title company will execute the documents, record them, and then you'll hire a property manager or you'll put a tenant in there and the tenant will start sending the money either to the property manager who will send it to us or the tenant will send it directly into your CAMA account. You'll go online and look at it just like you do at Fidelity and you'll see if the rent came in. If the rent didn't come in, you're probably going to call up the property management or the tenant and say, what's up? And, you know, tell them to pay their late fees at this point. Does that make it clean?
Yep. And the other thing is, like, since you're actually kind of talking about it, so there are a lot of don'ts, right? You're still dealing with the IRS and the government. So if you kind of, number one, do not commingle, right? Commingle funds and the other thing you just talked about was property management. You know, what happens if I, you know, manage it myself or I want to fix things throughout the house myself or paint it. So do you want to kind of talk about some of the big no-nos of, you know, that could kind of get you in trouble?
Sure, you know, but I'll reiterate them. Thanks for the question. But yeah, the IRS doesn't want you selling your house to yourself. They won't let you, your IRA, buy a house from your mom or dad or your kids or your grandkids or your grandparents. So there are what they call disqualified persons out there that you can't you or your IRA can't do business with if it's an IRA property. So for an example, let's say you bought this, but your son is a great handyman and can do all the fixing in there. Your IRA owns it. You can't hire your son to do that fix. You can't go in there and fix it because that's like contributing money to your IRA and they have limits on there. So my thoughts have always been, and I'm a hands-on control freak myself, so that was a little bit tough, but you can hire, you know, your plumber, your electrician, your carpenter and you can go there and look at the work and tell them what to do, but they have to get paid from the IRA. So you take the invoice from them, and some people want to know that they have that. So we'll send the check made out to the electrician or the carpenter, whoever you need it, and you can go over there, visibly look at the repair, and then give them the check or say no, fix it before you get paid. So there's all different kinds of ways that that can be done. Now, if you have a rental property, those same disqualified people can't be renting your property. And other ones are your partners. If you're a partner in a business, you know, they're disqualified. Any fiduciaries are disqualified. And one of the ways that we always tell people from an education standpoint, if you or your IRA is getting a benefit from what your IRA is doing right now, then it's probably prohibited. As an example, you probably have a lot of realtors on here, and they're in, you know, they're good at selling real estate. If their IRA buys a piece of property and they're the listing agent, they cannot get a commission on that property. Now their broker can, but they personally cannot benefit from their IRA buying that property. So that's a couple of the things that are there. You can't live in the property, and people say, what about 2 weeks? Or if it's not rented to somebody, can I go down the Jersey Shore or the Miami condo and stay for a couple of weeks? The answer from the IRS is no, you can't. Would we know about it? Probably not, but we don't recommend anybody doing that.
Yeah, we're like, today's idea is also give best practices. So, you know, just like what Carl's saying is, you know, you shouldn't be doing it. All it takes is one time to get caught, and then you got a problem. You're going to lose, there'll be some big fees on it too. What I'm going to do is I'm going to actually, there's a lot of questions, and I know Carl's son, Ryan's been answering them also, but there's some good questions that would be, I think, are pretty good for the group right now too. So let me see. Let me get back to here. Okay, so I have someone, anonymous. I'm retired now. Can I still contribute to a Roth IRA?
The answer is you can still contribute to a Roth IRA. Are you making, the main concern is, are you making any earned income? The second thing that you might want to look at is, do you have a traditional IRA or a 401k that you might want to convert to a Roth IRA? That's another way to fund them. Now, let me just explain to you, people said, well, why do you want them to get Roth IRAs? And I'm just telling you from my perspective, I think it's a good thing. Camaplan does not make any more. The fees are exactly the same for a Roth IRA as it is a traditional IRA. We're big on passing on things that we believe in and that we've seen other smart clients do, and their rationale for it, and their you know, advisors recommend them doing.
Yeah. And that's good advice. And so Aurelius Diaz, if I have a 401k through my previous employer, but I'm no longer employed, what options do I have with it? Wondering if it can be moved to a self-directed.
Absolutely. Those are the easiest ones, you know, unless he's a ex-NFL player, because the NFL makes it tough to move your 401k, but most 401k companies will allow you to take it out. You have to fill out their forms and you'll tell them you're going to roll it over to an IRA, and you want to do a custodian to custodian rollover. Otherwise, they'll take out that money and send you a check, and they'll take out 20% of it. So let's say if you had 100,000 and you said, well, send me my money, they're only going to send you 80. You're going to put 80,000 into a Camaplan account. And once the IRS sees that you did that within 60 days, the only tax you're going to pay is the 20,000 that they didn't send, that they sent to the IRS. That's sitting there for you, and you'll get a tax refund. but you'll also pay tax on that $20,000 and a penalty of $2,000. So if you're going to roll over a 401k, try to do it from administrator to administrator.
Yeah, I mean, and I've seen that mistake a few times where, they left a job and they said, oh, I want to get into real estate, and they cashed it in, and then they got hit with a tax bill, and then they put it into an IRA later. So I've seen that mistake. Those are costly mistakes. Make sure you also talk to your accountant, the administrator, also, and like what Carl's saying, custodian to custodian, you usually won't have any problems. And actually, let's actually kind of talk about that, because how long does that process take? And I'll tell you why. Because what happens is, you're a real estate investor today. You're like, oh my God, I learned this thing about self-directed IRAs. I want to buy something today, but I know we're picking on Fidelity. My money's at Fidelity. How do I get moved over? Like, what kind of time period, does it take to open up an account or move money? Is really what the question would be generally.
Well, yeah, no, that's good. And you can open up an account, basically online, and it'll, you'll get a number, I think 5 minutes after you fill out the forms. But for us to do the background checks, et cetera, it'll take 24 to 48 hours, and you have seven days to basically recant if you don't like what you did. But saying that, now to get money from Fidelity or Vanguard or one of the Pershing, one of the brokerage houses, and they're all different, by the way. And since you are beating up on Fidelity, they are actually one of the quicker ones to get money, but they get it in about 2 weeks.
Okay.
Some of them, will take 4 to 6 weeks, and other ones will, kind of milk it. It depends on how much you're taking. If you're taking all of it and closing out that account, they'll come back to you and say, why are you going? We'll give you four free trades or something like that. And sometimes they'll say, oh, your signature isn't the same as you opened it. We want to really verify it's you. And a lot of times you'll need medallion signatures. So it can become somewhat of a hassle, but we're the only company out there that doesn't charge you an annual fee when your money's there. We don't charge any fees except to open the account. And since if you're a Broward REIA member, that's, I think, down to $25.
Yeah, we worked out something pretty good with you.
Yeah.
So that's why you definitely want to be one of our members, and they will verify with if you're a member. So you can't just say I'm a member and squeeze in. So someone just got a good question. Can you use your IRA only for the down payment for investment property? So I'm assuming
say it again.
I'm assuming she doesn't have enough money to actually buy the house or the property. So we're going to go by that assumption.
Okay. So let me talk about that a little bit, because that is another great question. One is, yes, you can. Your IRA can put down the down payment, and it's the only one putting money into it, so it owns it 100%. So now you say, well, how does it get to own the property? But the IRA has to get the loan as well, and it has to be a non-recourse loan, which means there's no recourse for the bank or the lender, which, by the way, could be another IRA, to take any more money from the IRA. The only thing they can do is foreclose on the property. So in that case, most of the time, with the lenders that are out there and the banks, you have to have a 30% down payment, and then the banks will generally lend on the real estate. If it's a house. Now, if it's 10 acres of land in Wyoming, they're probably not going to do it. If it's a mobile home, they may not do it. If it's farmland, they may not do it. So there are a couple of things that the bank won't lend for IRAs, but they generally don't lend to individuals in those arenas either. Does that make sense?
Yeah, and to add to that, that means you can't personally guarantee it. So a lot of lenders, right, if you're getting a business loan, depending on the lender, and it's a regular loan, they're going to make you personally guarantee it. there are lenders out there that will do non-recourse. So non-recourse, they can't go after you personally. They're going to take the property back if you don't make payment. It's probably the easiest way I could say that. We do have, just so you guys know, I know some of you guys are investors. We have some of our local hard money guys, and they will actually lend on a self-directed and IRA, and it is non-recourse. So if you ever need some lenders on that, just message me or email me. I'd gladly, provide 2 or 3 lenders that actually do hard money loans on those. So I think that makes a big difference for a lot of people out there as they're starting to get into the arena. And then I know we kind of talked about, you want to go ahead and talk?
Yeah, I just want, yeah. The other thing too is when you do use leverage and take out a loan, there's a good chance that you'll have what's called unrelated business income tax, which the portion of it is unrelated debt financed income. So let's say you had a 50% down and borrowed $50,000, 50% of that income for simplicity would be taxed. And it would be taxed at trust rates, which gets up pretty high. I don't think it's a killer. I think that, but I do want everybody to be aware of it. I want you to talk to your accountants and see exactly what it is. A lot of them aren't familiar with it, but you can look at Form 990T, which has a small instruction booklet, and it explains exactly how it works. It's like a Schedule E on your personal tax.
Yeah, and so what's kind of funny, so I know there's some newbies on there and they haven't really worked with their IRA, but they're doing deals. So let's say I only had, I don't know, $5,000 in my Roth IRA or traditional, whatever it is, but I know I'm a deal architect. I know how to do deals, but I call up, Mr. Carl Fisher, who's got some money, and I say, hey, how about we do a partnership? And, I'm a little bit greedy, so I need to make 60% of the profit, right? Versus you make 40%. Do you see real estate investors do that, or is that the quickest way, or one of the quickest ways to build that balance versus actually doing a loan? Like, what are your thoughts, or have you?
Yeah, no, I've seen that. I've seen people take down a deal, and they'll put $5,000 down, as earnest money on the contract. They'll put it in the name of their IRA. And then what they'll do, let's say, for round numbers, let's say it's $100,000 deal. They'll go out and they'll sell, in your example, they'll sell 40% of this deal, for $45,000 or for $95,000, they'll sell 40% of the deal. Now you've got your 100,000, and on the deed, it'll say the IRA is 60% ownership and the money man is 40% ownership. But if you take your example of the one you and Ryan did, look at the money that they would have made by having 40% on that. They would get their $95,000 back, but then they would have split 200,000, 60-40. Yeah. So 40% of 200,000 is 80,000. They would have almost doubled their money.
And the good thing with that is, right, like that was my biggest concern in the beginning, was that low balance. So if you know how to do deals, right, you're a real estate investor, you're wholesaling deals, or, what Ryan and I do is like we pick the biggest ones, obviously, to make sure to get the maximum benefit. But it's an easy way to build your retirement account. Of course, you can't use the money right away. So I know, as real estate investors, right, you still need to eat. Okay, go ahead and buy in your LLC, but, maybe 1 out of 5 deals. I don't know. I'd probably put in my IRA because, people always ask me, they said, well, you're not, you can't withdraw the money right now. And I said, well, I'm using it for investing. I'm not looking to withdraw the money. I'm looking to build it tax-free. So I think that's some of the challenges. People have I had a mental block. Like I didn't have enough money. Or the other end of it is I've seen also, what's the youngest person or age that you've actually opened up that actually has a Camaplan account? So do you have Do you know?
Yeah, I mean, obviously there's educational savings accounts that are opened up at birth for kids in education. And by the way, you can use those immediately because, you know, kindergarten through college and postgraduate school, you can use
You
that
want to
money.
explain what that is actually, so that like what those kind, I know a lot of our viewers have kids,
Uh-huh.
so maybe touch
Well,
on that. I know.
yeah, the educational savings accounts is another way, another tax advantage plan, a lot like a 529 account, you know, set up for college and other educations. But it's set up for kids where you put taxed money into these accounts. And if they're used for education purposes, all the earnings are tax free. And they go to pay for books, uniforms, tuition, board, room and board, etc. Any associated educational expenses. And you know, there's health savings accounts that will do the same thing, and I love those because the money going into those is tax deferred. You know, so then you don't pay any tax on it, and then when you pull that money out and you use it for health expenses, that is tax free. So again, if you come up with a catastrophe or you're sick or you can use that money directly. Now, I tell people to save it if they can, um, but you know, if you need it, it's there for you. And if you don't need it, it's sitting there earning tax-free money and growing and growing. The other thing you talked about was, hey, if you don't have enough money and you have to sit there, but if you took that 5 or 10,000 and you put that in your 81-year-old father's Roth IRA, and you made that money, guess who could use it right away? Your father, right? And I bet he'd buy you a few lunches or dinners or maybe another car to drive around in, you know, if you helped him out like that.
If you ask him, he's going to say the same thing. I've already bought you too many lunches, and you're already too expensive. You're on your own.
Yeah, but at least you've helped grow his IRA and paid him back then, right? You
Exactly.
know, you're paying it forward. So there's a lot of strategies out there. And you talked about why people don't know about IRAs and 401ks and these tax saving deals. And, you know, I can't believe this. Is it legal to have a Roth? Well, guess what? There isn't any sex and sizzle in IRAs. If you go to a dinner table and I'm not there, I doubt very seriously anybody's talking about IRAs, and probably only 10% of the time when I'm there, unless it's on a cruise or something like that. So they just don't get, they're not as exciting as talking about a fishing trip or a golf outing or your next vacation. You know, so that's one of the reasons that this doesn't get a lot of coverage. But I'll tell you right now, the wealthy all have them and they use them. And a lot of them, they got wealthy because they use them.
Yeah, and so so one of the points I definitely want to touch on again was the HSA. So they get the tax break up front.
Yep.
Right, and then it grows tax free. And you could, you know, since it's self-directed, your HSA, your Roth, your traditional, can you combine? Do you want to talk about how you could combine accounts?
Yeah.
To percentages too, because I know, you know, I know a lot of people that actually do that too. They do combine them with their kids. I wish my wife would combine her account with mine, but I think the only way it combines is if I combine with her. So she's not willing to share, but I'll have to work on that. That sounds like a personal problem, but
yeah. No, it sounds like, you know, my life too. There's our money and her money. So you know, we had one family there. They had eight children, and the father opened up an educational savings account for each of the kids. And anybody, you know, he paid his kids, you know, over 6 to do different chores and things like that. So he opened up Roth IRAs once the children got old enough to have earned income. I think he may have even put one of the younger ones and paid him modeling fees on his business, his real estate business. So there are ways, as long as you can get earned income to your kids. So if you had, let's say 5 kids with Roth IRAs at 5,000, there's 25,000. You put 7,000 in a HSA, and you put, money into the ESAs. Now there's 2 ways of doing that. Some people will put them into an LLC or a trust, and make them all members of that. Or you could actually buy a property and have tenants in common with each one of those IRAs, ESAs, and HSAs listed as a owner. Obviously, the deed would be, a page and a half long with the ownership part of it, and there'd be, signatures. But that's primarily the way that's done it. Most people will form an entity if they have, 4 or more, IRAs or 401ks that they're putting in there. And some will do it with 1, 2, or 3 as well. So, and some attorneys think that you get better asset protection by having them in LLCs. And some people will open up a separate account, Roth or traditional account for each property that they own. And people don't understand that you can have more than one Roth IRA. You can have, still have money at Fidelity in a Roth IRA in stocks and bonds. And then you can have money at Camaplan, on a rental property or a note that's paying you monthly.
Yeah, I mean, there's a lot of options out there. So I know some of you guys are new. Take a deep breath. I know we're talking about, I remember the first time I was listening to all this stuff, my head was like ready to explode. So the idea today is about opportunity. So we just want to make sure there's like when I met Carl, he's got a ton of clients, and, obviously he's very smart. So I said, hey, I'm just going to do what smart people do, and, ask him all the questions. And there's a lot of different things that you could do to build wealth. I did have a question, is how much to open up an account? What's the minimum balance to open up accounts, whether traditional or Roth, solo? Do you have a flat minimum or something?
We say $4,000, but ESAs can only be, have limits of $2,000. Most people, you need at least 4,000 to get into a deal, put a down payment on something. There are people that, try to do it other than that, but that's basically what it is. And also the $4,000 limit, anything over $4,000, we don't charge a fee for having your account there until you actually do a deal, and make money. So, and less than 4,000, it's too hard on our bookkeeping, and we don't really want to do it. So, you have to have deals like you're talking about, you and Ryan did, or partnering with somebody to set it up. Because some people do like to toe dip and try a few of those things, but, you're not going to be able to get a loan on something with $4,000, but, unless you've got some financial friends or connections that are there, which some people do. So, yeah, 4,000 is the minimum, and some people say, I'm over 72, can I have one of these accounts? And the answer is sure, you can definitely have one. And the people that, have these accounts are always looking, to give their parents or their grandparents the money and help them grow it, because that money is going to be used now, I'm thinking about breaking up my IRAs and possibly giving them to, making a beneficiary, for each one. And then those kids can help me find investments for the IRAs.
If you want, I could be one of your beneficiaries. It doesn't have to be one of your kids or anything. So, I have no problem. I could volunteer. Send me the paperwork. It's easy. I know, okay. Ryan, right now, your son's like, what?
Yeah, right. Yeah. Let's watch this Anish guy a little closer.
Carl, can you hear me?
I can.
Yeah.
There's a few questions Anish can ask them to you. I answered most of them in there, but there's a few other ones that I was gonna let Anish do Are you looking at those?
Yep, I sure am.
All right.
So I do have Jane is asking if you have your own small business, can you open an HSA and what are the new parameters?
Yeah, definitely. If you're paying your own insurance and you have your own business, even if you don't have your own business, you can open up a health savings account. And the only requirement is that it has to be a high deductible insurance plan. And you can just ask your insurance agent to give you information on that. And it's relatively simple. You can call the CAMA office and we can give you more details on it.
Yeah. And Sam's asking, can you repay more than $26,000 per year to a non-recourse loan? Not sure where we got the 26,000.
But yeah, you can pay as much as you can pay as much as you make, you know, and that well, it brings up a good question. As an example, you know, it depends what the loan paperwork talks about too. That was agreed to, but don't confuse earnings with contributions, right? In a traditional or Roth IRA, you can only do $6,000 or $7,000 if you're over 50. But your IRA with 100,000 in it can make 10, 20, 30,000 on top of that contribution. So what your earnings are has nothing to do with your contributions. So you can pay back the whole loan if you want in the same year.
Got it. I think he was saying that you got the 26,000 because the limit of contribution to his 401k. So, okay, makes sense. Yvette's asking, can you assist with setting up trust funds and proper way for LLC, or do you open that first and then open an IRA under an LLC? Like, should she speak to the attorney first to get those structures set up first, or open the IRAs?
Well, yeah, there's a couple ways you want to look and research checkbook IRAs. There are attorneys that specialize in that. It was based on the Swanson versus the IRS case. So if you have an attorney that you like, you can have them get trained on your dollar reading the Swanson case and set up the LLC like that. But you should pay them from your IRA. So what you do is open up your IRA, put some money in there, and then hire the attorney to open up the LLC. And then when the LLC is formed, you take the IRA money, put it in the account, and then pay the attorney. That's how the majority of them work with these things. But you do have to have specialties in these arenas so that they're not disqualified and you know what prohibited transactions are. And hopefully your attorney will work with you when you're forming it as well as after it's formed and you're looking at different investment types.
Yep. And I have Pierre. First of all, Pierre, I want to let you know, you actually won the REIA membership. So it's funny that he's got a couple questions. So congrats. Make sure you call our office. We'll get you all set up on your membership here. But Pierre is asking, can you use one Roth IRA account to invest in multiple niches, or does it have to be an account for each type of niche?
Nope, you can use one account to invest in all different types of niches. I would just caution you to look at the assets and look at the liabilities associated with them and possibly set them up. You know, if they don't have any liability, then yes, go ahead and do it. When I say liability, someone that owns a house has a higher probability of getting sued than somebody who has, you know, is holding the mortgage on the note or on the house. So just look at the asset class and look at the liability associated with it, and then determine on how many accounts you want. But yeah, you can have one account that does all your investments.
And let's see, and Kenton's asking, does your company or do you offer strategy sessions or seminars for real estate investors? So I know
I was going to jump in there, Carl, and on that question, we don't give any tax advice or legal advice, but we do a lot of educational stuff like we're doing today. So there is recorded webinars on the website But if you're talking about, you know, what type of accounts you have and how do you move them and that stuff, you know, we can help you with that. That's no big deal. You can just call the office and ask for me, Ryan Fisher, and I can help you with that. But we don't tell you, you know, if buying 123 Ocean Ave is a good deal or not. You have to do that on your own.
Yeah, and we don't fill out the LLC paperwork, etc. You'd have to have your attorney, and we would like you to use an attorney near you, if possible. And we have
real estate attorneys within our organization. So if you guys do need that, let us know, and we could gladly refer you a couple of attorneys, and you know, you could talk to them who you feel comfortable and price, and that'll probably be a little bit easier for you.
And we'll also jump on a call, you know, free to help explain to the attorneys what they're trying to do and where they can go look. And obviously, we've got a lot of paper or access for the attorneys on different court cases that talk about this stuff.
Yeah, and I just threw a quick poll up there just because I know, you know, the first job is to figure out structure and how to do stuff in your retirement. But we do have a coaching program here where we put up 100% of the money for the deals. And, you know, we could teach you how to find those deals and then put them in your retirement accounts. So the money is tax-free, or how to raise money, all the above too. So I think I just wanted to go ahead and put your information, and our office will give you a quick call back to set up an appointment with one of us too. So, you know, I know we've talked about a lot of stuff. We still got a few minutes too. What do you think, right? I mean, obviously, and I'm not gonna be the political guy and stuff, right? With whatever's happening with inflation, taxes, you know, what are your thoughts on real estate? Because and luckily I've had dinner many times with Carl. So I always like hearing, you know, I'm going to say in the nicest respectful way, he's been around. So, you know, he's been through ups and downs. You know, what do you tell people about, you know, real estate investing or in general? And again, this is not advice. I know Camaplan it's not giving you any advice or what to invest in.
No, but we see, you know, hundreds, if not thousands of transactions, right, a year. And the first thing I want to say about real estate, and I think my father said it, is there is no national real estate averages. You can put stuff out there in numbers, but real estate is local, and it's almost to a street and a house. You know, if you go to the big cities, if you go 3 streets over, the neighborhood is completely different. You know, the Jersey Shore is different than South Beach, you know, than Laguna Beach in California. But I'll tell you where I don't want to be right now from a real estate standpoint, and that's in the Northeast, Connecticut, New Jersey, and New York. People are fleeing from there. The taxes are high. The COVID has showed them that they can work from home. The New York offices are moving. I think Goldman Sachs just bought 43,000 square feet or rented in Miami Beach, up and down, you know, between Orlando and Miami. There's companies from the Northeast coming in. Houses are at their highest. All these wealthy people are selling their properties in these Northeastern states. They're still getting a fair amount for them, but not like they used to. So I would prefer to have real estate in the southern states right now than I would in Silicon Valley in California or the Northeast, because I still think that a lot of the jobs are leaving there. I think that a lot of jobs are done because the lockdowns have been there so long, and people like the weather down in South Florida, and they finally figured out that 95 makes it all the way here. So you know, you want to kind of look at that. I think office space is not as good as residential houses. I don't think condominiums and community spaces with COVID are as nice as even townhomes with yards. From what I've seen, those prices are going up where the other prices are not as, are not rising as much from that aspect. So I hope that kind of answers your question, Anish.
Absolutely. And you know, one thing I forgot to touch on, and I know you kind of, we kind of glazed over it a little bit about asset protection. Is there, or, what kind, let's say I own a couple properties or I own a building in my retirement account. So the question I always get is it asset protected or is it not? If I get sued, or what are your thoughts on that as you start owning properties or a portfolio in any of these structures? And again, I know no legal advice. These are your personal thoughts, I'll say.
Yeah. Well, here's what I've seen. Okay. If you're talking about asset protection, we could spend, half a day on that. But if you have a house, as an example, in that property, you have to look at, are you being sued from the outside or are you being sued from the inside? And what I mean from that is, are you driving drunk and you hit a school bus and, kill a lot of people, maim a lot of people, and put a lot of people, paralyze them and put them in the hospital? Do you have enough insurance to cover that? Probably not. Now, if they came after your IRA and 401k, it would be protected in most cases in that scenario, because now they're attacking it from the outside. And the rationale I've heard from government attorneys is, if they give you their retirement money, then they're going to have to take care of you when they get old. So they protect those 401ks and IRAs to, a maximum extent. Now,
does that, I was going to say, does that also include bankruptcy? That was the other question I always get too. Like, if I owned, and again, I'm not sure what the answer on that is either. So,
well, think about OJ. I always tell people, think about OJ Simpson, right? He got there, he lost his civil suit, and they still never got his NFL pension. So yes, those laws are pretty powerful. And now I think he's got free room and board in some state somewhere, I believe, right? Las Vegas or Nevada. I'm not sure. So the answer is yes. From the outside, you're protected. But let's say somebody sued from the inside. Okay, and I'll go back to that question. Can you have all of your niches in there? And let's say there was something done erroneously in one of the houses that your IRA owned. Well, you know that the IRA is going to get sued because it's the owner on the deed, and they're going to find that out, and they're going to send a summons to our office, even if they don't know your name, and they're going to say, we're suing based on blah, blah, blah. But you're going to have insurance on your house anyway. But let's say it overextends the insurance. Now, anything else that you have in that IRA, because it's been sued, is now subject to that order or that lien that gets put on your, if you're found guilty and liable for it. So some of the asset protection is, and it depends on your level of paranoia. Some people say, well, just have 2 Roth IRAs, one that holds property and one that holds your cash, because cash has no liability, right? Because you can transfer back and forth between them all the time. And then other attorneys will tell our clients, well, you should have that in an LLC, and then it's, even protected more. And then some attorneys will say it should be in a dual member LLC, and then go one step further, and you can put it in an offshore trust that doesn't have recourse with the United States, like the Jersey Islands or something. So it really depends on what you think the probability is, what your insurance level is, and what the risks really are. I hope that answered the question in the few minutes we had.
Yeah, absolutely. I mean, because, it always gets complicated, and there's a lot of information out there, but sometimes I feel like there's a lot of misinformation. And luckily, you have the bird's eye view with so many clients that you start seeing. And as you mentioned, they're speaking to different attorneys, and they're, the first job I always kind of joke about it is to make money. The second is to keep it legally, right? And what I'm talking about is, pay the least amount of taxes legally, right? Or,
Sure.
asset protected. And those are the things that when you're, even if you're new, it's important to start learning these things, and setting yourself up. Because even I know experienced investors, I know a guy right now, he does about 20 or 30 deals, and he doesn't and he never even heard of a self-directed IRA, right? He makes money, but then he's, complaining that he pays so much in taxes. So, I mean, that's some of the things that I think that's a little bit of a challenge, and that's why we have these kind of education. And one of the other good things I'm gonna finally even end is, what's the difference between your company at Camaplan versus some of the other self-directed companies out there? Like, why do they choose you? I know there's some, companies out there and check writing abilities or this or whatever the case is. Like, how are you different?
Well,
Give like a plug.
yeah, no, I appreciate that. I mean, one of the things is I'm an investor. My sister, who started the company with me, is an investor. We use these accounts, and as you politely said, I've been around. I've seen a lot. People like that experience, and they know that we're there for their benefit, and we want to help them. I do think our service is much faster and clearer. We do a lot of education, not only for our clients, but also for our people, so that they understand the different deals that are there. And we're flexible and can understand stuff. If you go to our competitors, you're going to get somebody that's on there and they don't know what a wrap mortgage is or an option or, a dozen other things that are there, or ask questions about non-recourse loans, where to get them, who has them, what's it cost. So we actually do this stuff, and it's our main throw. I was in the real estate world. I still am in the real estate world. And this is just the way that, people asked me to get into it after I was helping them because they trusted us, or trusted me and my sister more than they trusted the other people that were out there. And a lot of people, even when I got started, said, hey, there's a lot of crooked people in the business and they can run away with your money. And I was worried about it, the first deal I did. And, we're totally open and transparent. And one of the big things people like is if their money's sitting in cash and they're ready to do a deal, they're not forced to do it, and they don't get charged an annual fee because they can't find the right investment and they don't want to, rush out and get a investment just so that they save the fee. And we recommend that too. Don't rush for anybody. Do your due diligence.
And I think you were mentioning, like, when we were talking the other day for dinner, that most of your clients, or you have a big portion of your clients that are in real estate, right?
Sure.
They're actually using IRAs and versus other companies out there that I know that it's kind of just sitting there doing nothing, versus you guys, really, I don't want to say push, but partake in real estate investing.
Sure, and we have a big network of people. We obviously belong to national REIA, and we have real estate investors all over the country, which gives us a pretty good perspective of what's happening in different areas of the country, as you touched on a little earlier, Nish.
Yeah, and as I said, obviously you're a wealth of information. You're actually doing it, being an investor. So I think that makes a big difference. Today we only touched on some of the small things. Sorry about the background there. We touched on some. We didn't even talk about wrap mortgages. There's solo 401ks. I know you guys are going to have a ton of questions. So in the chat, we actually put their information, Ryan Fisher's information there, his email. We do have that special pricing for REIA and Miami-Dade REIA members if you want to open up accounts. And I know you guys are going to have a lot of specific questions on your own accounts. So, go ahead and, feel free to, contact Camaplan, especially Ryan. He will help you out again with all your needs. And, if you want to transfer, you want to open. Today was just basically just a rough way to, to get you involved in, real estate investing using your retirement account. And, It's been a true pleasure. We do also have upcoming events tomorrow night. We have an event called Crushing the Foreclosure Market. It's our monthly meeting. It's at 7 p.m. Make sure you guys sign up. It's free. Alexa actually already put a link for it. So, make sure you sign up for that. Any last parting words you got, Carl or Ryan, either one of you guys?
Yeah, the thing I'd say is go to our website, camaplan.com, CAMAPLAN.com, and you'll see a lot of information there. It'll answer a lot of questions. I think we won some awards for it. It's pretty easy to navigate, and you can open up an account online right there. But again, if you also want to schedule an appointment, Ryan or one of the account executives will schedule an appointment at your time when you're available, or hit them with the emails and the questions, and they'll answer them that way, either with a phone call or an email. So we're here to help and answer questions and help people no matter what their situation is. And some people, it does make sense to do an IRA, and other ones it won't. And we won't try to talk you into doing one if it doesn't make sense.
Yeah, you got to make it a win-win. The other thing, I mean, for me personally, I wish I would have started my IRA younger. It's never too late is number one. Some of you younger viewers out there, it might not seem like much, but before you know it, you're like, wow, I got something substantial. So, even if you can't do the 5,000 or 6,000 for the year, you got to start building somewhere, is what I tell people.
Yeah, and they don't teach you this stuff in school. You've got to start somewhere. This is a gift from the government. If they can give you one, they're just not going to take as much of your money. So I would say take advantage of it while it's here.
And I'm just going to mention one thing real quick, Anish, that a lot of people ask me all the time, since you have a pretty big reach and crowd here. It doesn't matter how much money you make. Everybody can have a Roth. If they need more details about that, I'll talk to them on it. But, everybody on this call today can have a Roth IRA.
Perfect. Good information. He's right, because I know there's income limits, but there's different things you could do. So like Carl said, we could probably spend 3 or 4 days going over options and things that you're doing. And yeah, we want to give you 90 minutes with as much information as possible. I want to thank Carl and Ryan for being part of this event, and kind of just having a chat with us, really, to get rid of some of those myths. What would be great is that after some of these guys open up an account at Camaplan, I'd love to hear a success story of how you bought a house in your retirement. For us, it's good. It's a win-win. We're actually doing it. And, if you've actually seen some of our webinars, Ryan and I, Coolman here, we actually put up the HUDs showing us buying it in our IRA. So we really practice what we preach. I also want to thank, Camaplan for becoming one of our new corporate members. So you will see their information on our websites too. So again, Carl, Ryan, thank you so much for giving us 90 minutes of your time and basically touching the surface a little bit about retirement accounts. If this did not get your mind going, I don't know what will. If it's overwhelming, take a deep breath, right? So I have my friends that, don't understand finances, don't like finances. Call Ryan at Camaplan, start with something, don't get overwhelmed, right? So that's part of the important things, is that, doing nothing is not going to get you anywhere, right? That's no longer an excuse. Otherwise, I'm going to hunt you down. No, I'm kidding. So no, but thanks again. Carl, any last final words you want to tell our audience here?
No, I loved your advice. Get started, open up an account. I think it's a small risk to do that, and it can have, as you said, life-changing rewards if you work them properly.
Yeah, and you know what I forgot to add? I'm going to add to that is, especially my investors that are doing deals and they're running out of money, the fastest way to raise money is through other people's self-directed IRAs. So if you don't have one, you cannot tell your family or friend and say, hey, you should really do a self-directed IRA and then you'll fund my deals, right? They're going to ask you if you have one. So that's what really changed my business pretty quick, was as soon as I learned about self-directed IRAs, I was able to raise a lot of money for deals. So I'll leave you with that. And again, thanks, Carl. Thanks, Ryan. We will have the replay up on our YouTube channel within 48 hours. You will get an email from Alexa, our manager, for the special gift that we have Carl Fisher doing for us here. And hopefully we'll see you guys tomorrow night at 7 p.m. Thanks, guys. Thanks,
Thanks,
Carl.
Anish. Appreciate it.